price that is dependent upon or derived from one or more underlying assets or benchmark. The derivative itself is a contract between two or more parties based upon the asset or assets. The derivative values are determined by fluctuations in the underlying assets. The most common underlying assets include stocks, stock market indices, bonds and other debt instruments, exchange trade funds or ETFs, currencies and commodities. Characteristic of derivatives. First, they are liquid and have low transaction costs. Second, the margin requirements for derivatives are relatively low, reflecting the relatively low credit risk associated with derivatives. Third, they are traded globally and have strong popularity in financial markets. Fourth, taking a short position in derivatives is more comfortable than in other assets. An investor is said to have a short position in a derivative product if they are obliged to deliver the underlying assets on a specified future date. In the derivatives market, multiple parties participate with one party assuming the risk while another seeks increased leverage by paying for the derivative contract. These contracts are traded over the counter or OTC or on an exchange. For OTC derivatives, there is a higher degree of counterparty risk. Counterparty risk is simply the risk that one of the parties involved in the contract defaults on their obligation. These parties involve hedgers who use derivatives to protect against adverse price movements in underlying assets, such as commodities or currencies, aiming to minimize potential losses or stabilize cash flows. Investors who trade derivatives to profit from price fluctuations in underlying assets or gain exposure to specific markets or asset classes without necessarily managing existing risks. Speculators who intentionally take the risk from hedgers in pursuit of profit for a short period. They are willing to take risks and depend on whether the markets will go up or down. Arbitrators who exploit temporary price differences between related assets or markets by buying low and selling high simultaneously, aligning prices across different markets. Margin traders who use borrowed funds or margin to amplify their positions in derivative contracts, potentially increasing returns but also exposing themselves to higher risk due to leverage. They aim to magnify profits from price movements but must manage the risk of margin calls or liquidation.
The purposes of derivatives are as follows. Risk management or hedging. Derivatives allow the management or hedging of various types of financial risk, such as price fluctuations, interest rate changes, currency exchange rate movements, and commodity price volatility. By using derivatives, market participants can protect themselves against adverse price movements in underlying assets. Up next, we have leverage and speculation. Derivatives enable investors to gain exposure to underlying assets with a relatively small initial investment, known as leverage. This leverage allows investors to amplify potential returns, but it also increases the level of risk. Speculators use derivatives to bet on the direction of price movements in underlying assets without owning the assets themselves, aiming to profit from favorable price changes. And lastly, we have arbitrage opportunities. Derivatives markets facilitate arbitrage, the practice of exploiting price discrepancies between related assets or markets. Arbitrageurs buy and sell derivative instruments and their underlying assets simultaneously to profit from temporary price differences, helping to align prices across markets and ensuring market efficiency. Positions in the derivative market consist of the long position and the short position. Investors in the long position have bought and owned shares of stocks. For instance, an investor who owns 100 shares of Tesla stock in their portfolio is said to be long 100 shares. This investor has paid in full the cost of owning the shares and will make money if they are sold at a price higher than their purchase value. On the other hand, investors in the short position owe stock to someone but don't actually own them yet. For example, an investor who has sold 100 shares of Tesla stock without yet owning those shares is said to be short 100 shares. This investor owes 100 shares at settlement and must fulfill the obligation by purchasing the shares in the market to deliver. The first type of derivative instruments we have is forward contract. A forward contract is a private agreement between a buyer and a seller where the buyer commits to buy and the seller commits to sell an asset on a specified date in the future at a presently agreed price. It is usually a particular commodity such as oil, gold, or cattle. The parties involved can customize the terms of their agreement and settlement process as they want. The underlying asset can be a physical asset or tradable equity, and price movement of the asset determines who gains and who loses in the transaction. If the price goes up, the seller loses while the buyer gains because the asset is obtained at a lower price than the market value. Both parties may be using the contract for speculation or to hedge their exposure in the market. For example, let's say the current price of corn is $1,020 per ton, and the corn farmer, whose cost of corn production is $850 per ton, is afraid that the price will fall below production costs when his corn matures in 4 months' time. At the same time, the supermarket distributor thinks that the price may get up to $1,200 per ton by then and cut into his profit margin. The corn farmer may decide to enter a forward contract with a supermarket distributor to deliver 10 tons of corn in 4 months' time at $1,000 per ton. This helps the corn farmer lock in his profit and assures the supermarket distributor of corn supply at a reasonable price. If in 4 months' time the price of corn increases to $1,200, the distributor gains in getting a cheaper supply of corn, while the farmer loses out on the opportunity to gain more profits. Forward contracts are traded over the counter, and being an OTC traded derivative, there's a higher degree of counterparty risk, a type of risk arising from the inability of either of the parties to meet the terms of the agreement.
Well, the next one is the futures. A future contract is similar to a forward contract because it is also an agreement for the exchange of an asset on a future date at a presently agreed price. However, futures are traded in the secondary market, the exchanges, and are highly standardized with rules and regulations backed by the clearinghouse. In future contracts, both parties interact through their brokers and the clearinghouse. In other words, the buyer and the seller don't enter into a private agreement. Instead, each party is in an agreement with the exchange. The exchange decides the size, format, and expiration of the contracts, so the agreement is not customizable. Furthermore, both the buyer and the seller provide initial and maintenance margin, which determines the amount of leverage, and the exchange enforces settlement procedures that usually involve daily settlements of gains and losses by the parties involved. This helps to reduce the chance of counterparty credit risk. For example, a commodity trader buys a future contract for crude oil, agreeing to purchase 1,000 barrels of oil at $60 per barrel in 3 months. If the price of oil rises to $70 per barrel by the contract expiration, the trader can sell the futures contract at its profit. Well, the next one is the options. This is a contract which gives the investor the right to buy the call options or the right to sell the put option, a set amount of the underlying financial securities at a pre-agreed price on or before the expiration of the contract. The holder has the option to exercise the right, but the issuer is obligated to fulfill the contract if the holder chooses to exercise it. To have this special privilege, the holder must pay the issuer a premium in advance. The amount of the premium is not directly related to the asset's price. For example, if there is an investor who owns 1,000 shares of a stock trading at $10 per share is worried about the possible price decline, he can decide to hedge his position by buying a put option at $10 strike price, let's say with a $300 premium. If the price later declined to $8 per share and he exercised his right to sell at $10 per share, he has prevented a $2,000 loss with only $300. Based on when the investor can exercise the option, there are 4 types of options. The first is the American option, which can be exercised at any time until expiry. The second is the European options, which can be exercised on the day of expiry. The third is the Bermuda options, which can be exercised only on a specific day. And the last one, and also the fourth one, is the Exotic options, which is specialized options with unique payoff rules. And the last one is swaps, a type of derivative contract where 2 parties can exchange their streams of cash flow within a specified period in the future. Swaps are the most highly traded derivative and are mostly traded over the counter, making them highly customizable. But there are also standardized swaps that trade on the exchange. There are several types of swaps contract: the interest rate swaps, asset swaps, cross-currency swap, credit default swap, commodity swap, and total return swap. Here are the benefits of derivative instruments.
First of all, derivative instruments facilitate the allocation, transfer, and management of risk without directly trading the underlying assets. They enable investors and issuers to hedge against price fluctuations and reduce the time gap between economic decisions and transactions. Now, second of all, derivative prices can also serve as indicators of future cash market movements, aiding in price discovery. For example, analyzing equity index futures before the stock market opens can predict cash market trends. Similarly, interest rate and commodity future prices provide insights into market expectations and supply-demand dynamics. Now, third of all, derivatives offer operational benefits such as lower transaction costs, high liquidity, and minimal upfront cash requirements compared to cash or spot markets. They also allow for easy short position with low associated costs. Fourth of all, and lastly, derivative markets enhance operational efficiency, leading to greater market efficiency overall. They facilitate the exploitation of mispricing, with fundamental values often reflected earlier in derivative markets than in cash markets. Of course, derivative instruments also comes with risk. First of all, derivatives' high operational efficiency attracts speculative use, increasing the potential for financial distress due to implicit leverage. Second of all, derivatives introduce portfolio complexity and undisclosed risks, complicating investors' understanding of their exposures. Third of all, basis risk arises when the value of a derivative deviates from that of the underlying asset, leading to unexpected losses. Fourth, differences in cash flow timing between derivatives and underlying transaction can result in liquidity risk, particularly if margin call requirements are not met. 5. Derivatives expose parties to counterparty credit risk, with varying degrees depending on the instrument and market. Over-the-counter derivatives carry higher counterparty risk compared to exchange-traded derivatives. 6. Excessive risk-taking and leverage in derivatives market can contribute to systemic risk. Excessive trading increases financial market supervision to maintain stability.